In this video, I wanted to share the top 3 biggest mistakes I see first-time homebuyers make when trying to get financing to buy a house. Please make sure you watch the video till the end, as this can save you not only time, but also your earnest money. Because remember, when you're submitting an offer on a house, you have your earnest money, and that's something that you will lose if your loan gets denied by the lender. So make sure you watch it till the end. I'll share the top 3 biggest mistakes and things to look out for. Keep on watching. If we're meeting for the first time, my name is Peter Oreziak, and I'm a senior loan officer and certified mortgage advisor with Cherry Creek Mortgage here in the Woodlands, Texas. When buying a house, I know it's scary and exciting at the same time. A lot of times we'll go online, fill out an application, put all the information in there and think everything is good to go. There are things I would like you to be on the lookout for, because I wanted to focus actually on the top 3 reasons why a loan can be denied from a lender, okay? Why the underwriter can deny your loan. So one of the first things you need to be on the lookout for is undisclosed debts. And what I mean by that is I'm talking about tax liens, new student loans, child support, alimony, IRS payments, and timeshare. So these are the things that don't really come up on the credit report. You would think that everything comes up on the credit report. We see a bunch, right? Don't get me wrong, but there are some things that do not come up on your credit report. So when you're talking to a loan officer, that's why I always advise you need to work with a local lender, because we'll talk to you. We'll have you on a phone call or do a Zoom meeting or face-to-face meeting, and we'll have these conversations. We'll take a full application. We call it a full 1003, and we will ask you these questions. Do you have any undisclosed debts? Tax liens, IRS payments, timeshares. These are things that can come up later and bite you on the butt, right? And get your loan denied. And remember that when your loan is denied, it's not just losing potentially your dream home, it's losing your earnest money. If you wait too long, you might be 2 weeks in the process and you put your earnest money, which is 1% of the sales price, plus you pay for the appraisal, the inspection. By the time your loan gets denied, you'll be out 3, 4, 5 grand. So we want to make sure you avoid that, okay? The second thing is incorrect income calculation. What I mean by that is a lot of times when you fill out the application online, you put all the information in regards to income as your base. I'm talking about separating your base income. I'm talking about separating your overtime, bonuses, commissions. We can use bonuses, overtime, and commissions if we can average it over the last 2 years. But one thing that you have to be on the lookout for is that it cannot be declining. So if you had bonuses, overtime, and commissions in the last 2 years, but now it's declining, we can't use it. Okay, so you have to be so watch out for that. Be very careful with that. So make sure, you talk to your local lender, talk to your loan officer, and give them this information. When we look at the W-2s and tax returns and pay stubs, it doesn't show if your income is declining. Right now with COVID, after COVID, we started looking at P&Ls. We get something called also when you're self-employed, especially self-employed borrowers, if you have a declining, you can have 2 years of tax returns. Okay, everything is good, but we have to get a current P&L, current profit and loss statement. And if that is declining compared to the previous last 2 years, again, declining income, we can't use it. And during the process, we order something called the VOE, verification of employment. That's sending a letter directly to your employer, and they will break it down from us. And again, if you have your base, but then the overtime bonuses or commissions are declining, we cannot use the overtime bonuses or commissions. Okay, so that's something I need you to be on the lookout for, and just be careful with that, okay? The third thing is new debts, new loans. So that's financing a car, an RV, furniture, or even applying for a new credit card. Make sure you don't do anything like that when you are in the process of getting a house. These things will come up, and if you're tight on the ratios, it can potentially kill your deal going forward. And the main thing is, of course, to make sure you choose the right lender. Check them out, check out the reviews, talk to your real estate agent. I'm sure they'll give you a good reputable company and a good lender to help you with the financing. All of these can be caught initially in the process upfront, and that's how it should be done. That's what the pre-qualification really is, commonly known as the pre-approval letter. You do this research, you ask these questions up front, so later when you get the executed contract and you're ready to go, you can move into processing and underwriting very quickly. The last thing you want to do is to have a house you fall in love with, you put money down, earnest money, and then the deal falls apart, you out of pocket, and that might potentially, if you're a first-time home buyer and you lose a couple grand in earnest money, you might not be able to buy a house in some foreseeable future, because that's a big hit to your funds. So we want to make sure you're protected. Do the research. If you have Whether you're working with me or another lender, make sure you have a conversation and you disclose all the information, because these things will come up. So try not to hide anything. Okay, make sure you let the loan officer know exactly what they're looking at, what you have. If you have any undisclosed debts, make sure you let them know. IRS payments, timeshare, make sure you let them know if you have those. Everything is okay. It doesn't disqualify you from buying a house. It just needs to be included in the debt to income ratio. Okay.